Thank you for spending time with us this evening for the investment panel. Brought a wonderful slate of folks here. I'd like to start out by introducing everyone. Let's start with Michael Cho, who is the founder at Dayview Capital. Michael, would you like to introduce yourself and say a few words about your organization?
Yeah, sure. So we're a private equity firm based in San Francisco. We invest in late-stage venture-backed companies, mostly focused on special situations that aren't a great fit for traditional growth equity firms. So this includes a lot of secondaries and structured primary rounds.
Thank you. And then we also have Matthew Monroe, who is a co-founder and managing partner at Fifth Era and Karetsu Capital. Matthew, do you want to say a few words?
Sure. So I'm Matthew. I'm based in San Francisco as well. I wear a couple of different hats. So Karetsu, as I think a number of you know, is the world's largest early-stage technology network of investors. And so we back a lot of companies through that. And then I also run the funds. We have co-investment funds, a blockchain fund of funds, and a real estate fund of funds. And then I'm also a direct investor in early-stage tech companies.
Next up, we have Craig Nolan, principal at Acadian Ventures. A few words?
Yeah. So Acadian Ventures is a fund manager that focuses on direct secondary investing. And we look for opportunities in mid to late stage technology companies. Been doing this since 2011, managed about 250 million and have done just over 300 transactions. And yeah, deal sizes range anywhere from $500,000 to 10 million plus.
Next up, we have Sven Weber, who is Managing Director of Shares Post 100 Fund.
Yeah, Shares Post has two main business units. One is the trading system for secondary direct transactions. That trading system just passed across the $4 billion of transactions line, so very active there. I'm running the Shares Post 100 Fund, which invests in a list of about 100 companies on the late stage tech side. We invested in 67 of them in the last 4 years, had about 20 exits, prominent exits just recently, Spotify, DocuSign, Sura, and we have companies both listed in Uber in the portfolio, so many of these unicorns are in the portfolio, and that's where we focus to invest in.
Great. So it's open to the panel as to what sort of trends you're seeing occurring in the secondary markets for private equity right now.
I can start. One thing, we focus a lot on employee liquidity, so we're working with a lot of founders and executives, and I would say those sellers have gotten a lot more sophisticated recently. You know, a VP at an enterprise software company might have contacted us, 2 years ago, and they would just be surprised that this was a thing, that they could even sell before a company was public or got bought, and they would be pretty clueless. But now I would speak to a similar type of seller, and they know the drill. They say, we're talking to you guys, also we're talking to Michael Beardsley, also we're talking to Shares Post and Industry Ventures. I'm looking for a 5% discount to the last preferred. What can you do for me? And I think that's that awareness has really grown, and the market's a lot more sophisticated.
Any other thoughts from the panel?
Well, I think the market goes through waves. Through waves, and if you look back, at least in the last 4 years, we had some period where, let's say 18, 24 months ago, there was a lot of excitement, not only in the secondary, also in the primary market, where valuations went, I'd say, reasonably high. Some people argue extremely high. And you had a period of normalization, things got us in the last 18 months. What we just recently see in the last, let's say, 2 or 3 months is just starting to heat up again on valuations on the secondary side, mainly on expectations of sellers, given there had been some high-profile exits like Spotify and DocuSign that went decently fine with the IPO. So now you see a readjustment of the expectation of the sell side. So if you look at the trend right now, we had high prices 24 months ago, correction in pricing, and now starting to heat up again on prices.
Speaking about prices, are there perhaps a couple of private stocks that your fund has purchased recently, and perhaps some thoughts on why you think these companies are attractive?
One that we've done recently, which we're really excited about, is a company called Dynamic Signal, which is a SaaS business for enterprise communications, and that one we've been buying quite a bit in sort of regularly, and that's it's really exciting. The entrepreneur was previously the founder of Adify, which sold to Cox, and so he's kind of done it before. Really impressive guy with a great team around him, and they're executing very well. Kind of high quality SaaS economics, good user economics, and so that's one where we've, the price is healthy, but we felt comfortable moving ahead.
Well, we just added Turo to the portfolio just 2 days ago, but it was announced. We added Circle on the digital token side, payment services. We added late to the portfolio Uber. We think it was healthy that SoftBank repriced Uber and got the valuation a little bit down. That helped us to get our arms around it. We stayed out of that for a while. We're adding about 1 to 2 new portfolio companies per month. That's the rate. And the logic is always, are the right investors in there? Do they have a certain amount of revenue, a certain amount of continuous growth? And are we getting the stock at a reasonable, for us, reasonable price with a visibility that we think that this can be a 2 to 3x in 2 to 3 years?
So do any of the funds invest in international companies, or is it mostly, investments in US-based companies?
For us, the cut is very easy. Spotify was an international one, Luxembourg registered Swedish company. International is challenging because you want to have ongoing access to information. Luxembourg works because they're even more reporting requirement than in Delaware or here in the US. So you have a continuous access to information. If you do that in India or China, it's more challenging. So for us, the bar is higher for international ones. We're not shying away from it, but the measure is, do we have continuous access to reliable information?
Michael, will you add to that?
Yeah, sure. So I think to your question right before this, one thing that's a little bit unique about our model is we actually don't market any of our portfolio companies, and so that's actually one of the reasons why a lot of sellers and companies like to work with us. We look internationally, but one of the things I think that's also slightly unique, and although I know this is the case for everyone else on this panel as well, is that a lot of our deal flow comes from inbound referral from people that we've served on boards with or co-invested alongside previously. And so I'd say we look internationally, but the network is strongest in the US.
Do you think that management of late-stage private companies is becoming restrictive or more liberal in terms of allowing secondary transactions of stock to occur?
Excuse me, LiLing, can you speak up just a little
Oh,
bit?
okay. All right.
Thank you.
You want to take it? I don't want to always.
Sure, yeah. In our experience, they're becoming more liberal. I'd say the high-flying names, Uber, Airbnb, Pinterest, and so forth, are still pretty restrictive, or will do programs like the tender that Uber just went through. But after you get past that level, I think management teams are more aware these days. It's not kind of a shock when an employee might approach them to sell, and they're aware that that's an option, and they know that they know of companies that have done that. So I think that social validation has kind of helped overcome that hurdle. They might still apply parameters like, oh, people can only sell up to 20 or 30% of their holding, or and if so, they should sign up for a longer lockup period, things like that. But generally, they're more open to it now.
I think that hurdle was always a little bit overstated, at least in my experience. because a lot of the companies, they were officially saying we are not doing it or not allowing it, and behind back doors and closed doors, they were allowing it. So if I look in the last 4.5 years where I'm an operation from this fund, we had 6 brokers on 420 transactions, and out of the 6, 5 changed their mind 2 weeks after. So I had just 1 broker out of over 400 transactions, and there was not a big history of brokers, let's say 4 or 3 years ago. What you see is a difference is when companies look at these things, where behind closed doors they still let them through, they look at what is the quality of the new shareholder. Companies are concerned to replace individual shareholder with another individual shareholder or a group of individual shareholders, which might be trouble down the road. So they definitely prefer someone who has more experience. Might be an institutional investor or someone who has transaction done before and is not a newcomer to these kind of companies. Because we all know not all of these companies will be performing fine. And 30 to 40% of these companies run in trouble. And they don't want to deal in a time of trouble with individual shareholders that bought at a certain price in the secondary market, had perhaps unrealistic expectations, and are making more trouble in the shareholder base, and keep the management away from focusing on solving the trouble they have on hand on the operations side, and have to deal with individual shareholders who had the wrong expectation going into the deal. So that's a major theme. That's, I think, perhaps for us as an institutional buyer, we never face this kind of a threshold, but I bet you face it more if you try to do it on an individual basis.
Matthew, you were a vocal participant on the panel 2 years ago, I believe.
Yeah, I remember that.
Yeah.
And I think you were sort of negative at that point about investing in late stage private equity and unicorns in general. So have you changed your stance on that?
Yeah, thank you. So so I think in order to explain that, I think first, just stepping back for a minute, we are in the middle of a fairly unique change that we've never seen before, which is that we are in the middle of a digital transformation of every industry around the world, and the profit pools that are in flux and changing ownership are increasingly being captured by new technology companies. And these unicorns are, as a result, becoming very quickly very highly valued. By design, they're choosing not to go public, and so they're continuing private ownership for much, much longer, which means they're having to raise much more capital to do everything they need to do. And the durations are very long. So Spotify, as an example, was over a decade before it got to its exit. So it's not surprising then that there are employees and co-founders and investors who need liquidity for one reason or another. The challenge is we haven't seen this quite like this before. And so 2 years ago, my concern was sort of what Sven just said, which was I was anticipating that 30, 40, 50% of these companies might be beginning to be faced by cash crunches. Large businesses, many times cash flow neutral or negative, needing to raise more and more capital and put that onto the waterfall. And today, as I look at the opportunities, it's sort of, for me, is it a great opportunity in terms of changing the world and building a big business? I think many times the answer is yes. Are these companies likely to be the winners? Possibly yes. Are their companies viable? Well, I'm still not sure. And then the question is it a good deal for us? And the challenge is, can you be high on that waterfall, or are you at the bottom? And most of the secondary market opportunities that I see, you're closer to the bottom than the top of the stack. And furthermore, you don't know what's still to come in terms of additional financing and additional deals, ratchets, other terms and conditions that could cause problems at the bottom of the waterfall. So I'm still confused, quite frankly, about what the timing of all of this is. And we used the Uber SoftBank example. The great news was Uber got more cash and they needed it. The valuation came down, which was good. But SoftBank did a sweetheart deal and stole the crown jewel out of Uber, which was the whole of Asia, and put it in a different company. So if you're at the bottom of the Uber stack, you just lost a big piece of the value of Uber. And it just happened, you know, at the sign of some paperwork. So I don't know what all of that means. If I was going to be a secondary market investor, and I have bought a couple from Michael, including Spotify, I would either look for deals where there's a lot of transparency, and preferably where, as in Spotify, it's an all common stock deal, so you don't have a lot of rights stacked on top of you. Or I might go into a commingled fund where, you know, Sven will only be famous if the performance of his fund does well. So it's not, he doesn't make money by selling you something, he makes money by getting a fund to perform. I feel like that's a better alignment of interests. But so that's, I'm still a little confused, not sure when the crunch is going to happen. I'm pretty sure that it will. And so as a result, I'm not sure which secondary market opportunities are the ones that you should invest in. And if you don't have clarity on the strategy, the fundraising, and the waterfall, how could you ever invest in the bottom of the waterfall, which is the common stock or the early preferred?
Yeah, and that is the main important point. Is whatever you invest in, you have to understand what you're investing in. And in these private companies, it's the waterfall of proceeds, understanding the preferred stock, different classes of preferred stock. And what I always say is understand what happens at a big payday. If you don't know at whatever valuation you pick, what happens at a payday and which shareholder is getting what paid per share depending on what they own, you should not invest at all into that, because you're not able to price it out. Typically, it is what you're saying is common stock is always last and preferred stock has rise, but even within the preferred stack, there can be significant differences. So we have that in our models. We know per company. Like in that company, we like preferred B and E, but not any of the other preferred, because there's some hidden things in it that we don't like. So you have to understand that. Otherwise, you cannot price this out.
Yes. So if I could just add one thing, Sven, to that is for all the angels in the room, we know that the round that causes us to be washed out is always the last round.
Yeah.
In other words, there's nothing you can evaluate in preceding rounds that will ever tell you what's going to happen in the last round. And the last round is subject to distress. And that's sort of the risk that you take when you enter into a proposition not knowing if the company will ever be public, if there is indeed a market for it as a public entity. Some of these companies are too big almost to acquire. So my son, one of my sons, is down at Oaktree in the distressed asset group, and they're just waiting to do the final round. And I promise you one thing, when they come into the market in a big way with $100 billion at some point in the next year or two, they won't be caring about me, you know, or any of us. You know, we are early than them. We're on the waterfall below them, and their only goal is to crush us and take us out of the equation. So that's sort of the fear I have. But on the other hand, I did really well with Spotify. Thank you, Michael. And it was you know, a 400% return or 500% return, so it was a good deal.
So has Keiretsu Forum and Keiretsu Capital considered late stage sort of private equity investing?
Right, so the answer is it's not something that we do. We're on the other side, so potentially we are a seller of positions in companies that either we have backed or our members have backed. That we've talked quite a bit about. In fact, we did approach SharesPost some years ago about creating a pipeline where we would show them all of our deals when we felt they'd matured to the point. But the problem is there's a bit of a gap between you know, a private early stage backed company maybe into its A, B round, V, the types of profile of companies that the SharesPost wants to see, which would typically be one of the world's most famous unicorns with a big marketplace, a lot of liquidity, a lot of, you know, valuation clarity and transparency. So we still have it in our heads that at some point we could potentially be a source of deals to secondary market purchasers. We've even thought about things like AngelList or other sort of technology-enabled platforms as being places to, provide those opportunities. But it doesn't seem a particularly liquid environment. So right now we don't do anything systematically in this space.
And this is for Michael. So you successfully raised capital for Debut Capital Partners and closed your first fund. Congratulations. Can you tell us a little bit more about the process?
Yeah, sure. Thanks. So we were really fortunate and grateful to find a private equity partner and a number of family offices that believed in us and what we're trying to do. And I think the most interesting takeaway that I had from the fundraising process was a question that a number of prospective and current LPs asked me, which is, isn't Acadian or ESO doing something similar? And the answer is yes. I mean, I think there are slight differences in execution and focus, but we're all doing related things. And I think what's more interesting to me is when you think about the total number of institutional funds that are doing something similar, it's still much smaller than the number of Series A, growth, or especially seed funds, right? And so what that says to me, and with the overlay being that I don't think this is a winner-take-all market, I think the biggest takeaway I have from the fundraise is that this is still a relatively new strategy for LPs. It's a relatively nascent strategy, and so that, to me, reflects the broader immaturity and also opportunity in this space.
So how do you go about selecting investment targets?
Me?
Yes.
Sure. So our deal profile is a little different in that we usually try to target one deal per quarter, and so that's really heavily influenced by my background in growth equity. And so we speak with a lot of large publics. We speak with early stage and growth equity investors, and we're really fortunate, as I mentioned earlier, that a lot of our prospective deals have come inbound to referral. And so I think our diligence process maybe more closely resembles a traditional growth equity diligence process. We do call it about a month of diligence for each opportunity, and I think the upside is occasionally that means we can stretch and candidly pay a little more than some other funds.
All right, well, Craig, Acadian Ventures was one of the largest common stock shareholders when DocuSign was private. Can you talk about Acadian's relationship with DocuSign, its management during that time, including any liquidity programs that you may have participated in to help shareholder liquidity?
So DocuSign is a really good case study for the direct secondary market. We were talking about how the duration is a lot longer for these businesses, and DocuSign was founded in 2004, if you can believe it. And so we had actually done a transaction with an executive at a different company prior to ever having been introduced to DocuSign. And that person moved over to DocuSign and introduced us to them, and we did our first transaction in 2011, and it was kind of a one-off, just kind of two sellers, executives kind of a thing. And then we had some additional opportunities through that relationship kind of come through in 2012, and then they organized a semi-formal liquidity program where a lot of people participated at the end of 2013, beginning of 2014. And so we participated in that to a large degree. But really, we've written a lot of checks between 2011 and last year, kind of sporadically, not necessarily at specific times that were organized by the company. They did do a large tender in 2015, I think, that followed the Series F and was at that same price, but we only participated to a limited extent in that one. But it's, as I said, it's a really good example of kind of companies that have these long durations and where there's a lot of people on board who need liquidity, and how working with us, we can kind of serve that as it comes. As companies have attrition and people that need option exercise help or other liquidity needs, we're kind of there. And I think we worked with maybe 40 plus different sellers there over the years, and now are finally eagerly awaiting the lockup expiration.
So prior to Acadian, you were a director at Archstone Partners, a leading valuation firm. So what are some of the valuation methods that Acadian uses when it values companies for investment?
So for those who don't really know about 409A valuation, what I was doing was helping companies price their stock options and essentially setting the fair value that was used for determining taxable gains. And companies want that value to be low, and so they game it a lot, and it's really it's BS to be totally frank. And so the valuation techniques are very different. Yeah. Now that I don't work there anymore, I can say this. But yeah, it's the valuation techniques are very different, and so coming from an investor's point of view, we determine whether it's an IPO or M&A candidate, and we kind of project an exit timing and size and path, and then we kind of discount that back by a kind of mid to late stage venture capital's sort of rate of return, and then as you guys talked about, run that through the waterfall to make sure the common stock still performs well. And hopefully that lines up with a lot of the rules of thumb that are out there in the secondary market that you might have heard, which are 5 to 20, maybe 30% discount off of the recent preferred issuance.
So I think it's just worth pointing out, Craig just said something that's important, so that if a founder comes to you and is trying to sell for whatever reason, it's smart to do the 409A comparison and basically say, you're trying to sell your stock, what was the last valuation? What's the 409A? Because as Craig's already explained, it's going to be low. And unsophisticated sellers, which is most employees, are going to not have much to argue with, because there is no other valuation typically other than that, and that is typically a low valuation. And if there hasn't been a financing event recently, it could be actually well out of the market. And obviously in the companies that spend, the unicorn companies, there's going to be a lot of trades occurring, which might set a subsequent price. But in most of the companies that we see in the Bay Area, there won't be any trading going on. So the 409A can be a useful way to get a low price, or at least the beginning of a low price conversation with the seller.
So the Share Post 100 is a publicly traded mutual fund, Sven. How has that affected the fund's investment chart and LP profile?
Well, they're no LPs, they're just public investors, so it's available for everyone. You don't need to be a accredited investor. Minimum was $2,500 to go in. So, but the investor profile is mainly ultra high net worth individuals and family offices coming in. This is how we market the fund. We're not going to classic retail. Actually, we try to avoid classic retail in the fund, as they are really headache. We had a group of, I think, 3,500 classic retail coming in. And again, similar to the same logic, companies don't like to have unsophisticated investors in the company. I don't want to have unsophisticated investors into the fund. But the chart is clear. It's according to the prospectus, which we had to file with the SEC, which took us 18 months to get through the SEC, because it's unusual to have a mutual fund that purely consists of illiquid private assets. It's not seen for a mutual fund really before. We had a large round valuation. That is because we price the portfolio every day. We report a net asset value on the complete portfolio every day. And that is an interesting operational task, as you might imagine, coming from the valuation space. By the way, the story there is just, I just had a discussion with the SEC, and even the SEC says what you're saying, that the 409A valuation is total bullshit, which helps a lot. The biggest challenge we have is right now when you're suddenly victim of your own success. So if you're running a public fund, you have to fulfill certain diversification standards, certain measurements more or less every day. We're saying your portfolio can only consist X% of that and Y% of this. So we had 3 IPOs within 3 weeks, and they all performed very well. So all of these things started to get out of whack. So that was an interesting new experience for me to run this on a public fund, to deal with kind of these diversification standards that are put in stone for public funds, whereas on private funds you can always run a temporary exemption. I understand this is there for shareholder security, which the SEC is very big on, and in the end, I think we managed through it, but that was a very interesting exercise. The other one is very interesting is if you report an NAV every day, investors and the public can see every day something is going on. And as you know, if you have a portfolio of private companies, normally there's not a lot happening from day to day, and then suddenly you have a jump up or a fall down, because either you had a major miss in the company and you had to adjust the valuation, so it goes down, or you had a nice new round or a nice exit suddenly, and it goes up. Typically, you know about these things even before the public knows. So people watch us and say, try to speculate what's going on. The other frustrating piece is you never get calls when you jump by 1 or 2% up. But we get calls from investors when we go down by 20 basis points and want to ask what the hell went on. So this kind of a reward with public investors is you get penalized for 20 basis points down, but nobody's giving you a clap on the shoulder for 200 basis points up. That's also a very interesting experience.
Yeah.
So looks like price performance has been going through the roof. You touched on it a little bit earlier, but what are some of the factors you think are at play here?
Well, we also had our share of coming down. So I think it's like, I compared everything what we're doing in different stages, early stage, more later stage, is I compare this often with investing in red wine or buying a bottle of red wine and a collection of red wine. You have to get the right label, the right vintage, you have to put it in a shelf, and you have to wait. Yeah? So, and then at a certain point you open that bottle and some bottles are corked. And some are really good. I think what you see right now is just we are investing with a 3-year investment horizon. We are in year 4 of the fund, and now you start to see the first bottles of red wine being opened. You saw some last year where we had a couple of corked ones, so we had a challenging year last year. But it's all made back up again by the good wines that were opened in the last 12 months.
I'd answer the question a little differently. I think that something that we often miss sitting here in Silicon Valley is that most of the capital in the world is being managed and invested in low returning assets. So fixed income still represents whatever it represents, 20 or 30% of most portfolios, and it averages 3% over the long haul, which after some fees means that they destroy value. Their capital shrinks. The public markets, broadly defined, are averaging 8%, but in this time frame, that's also a sort of a lie because the tech sector has been outperforming the average of the public markets, and the public markets have been underperforming, and the weight of the dollars is in the old companies that have been doing less well. Early stage tech, the VC average is 24%, but within the VC average, their early number is 32%, and their late number is about 12% or 11%. So what you can see here is that the investment returns are highly skewed towards early stage tech, as well as small cap real estate. But most of the weight of dollars in the world is in the wrong place. It's in fixed income and public equities and large cap real estate. So now you're a sophisticated investor somewhere in the world, SoftBank in Asia, or one of the sovereign funds in the Middle East, and you've got billions to invest. And for the last 10, 15 years, your professional managers have at best made a little bit of money for you, and more likely on an average basis have destroyed value for you. That has created this huge pent-up demand for these types of things. Give me access to the higher performing asset categories. I have a lot of capital, I want to put it to work. And the problem's been there's no vehicles. So the principal vehicle is actually American venture capital firms doing late stage financing rounds with very large investors in the pre-IPO marketplace. Right, so they may give Sven a piece of Uber, he puts it in his fund, But what they actually do is they give $2 billion worth of Uber, or whatever the number was, to SoftBank. And we're seeing more and more of those those are the real pre-IPO secondary market transactions of today. It was Fidelity and Wellington, then it started being Sovereign Wealth, and now it's these, you know, the Vision Fund, whatever it is now, $100 billion venture capital fund managed by SoftBank. And along the way, new products are surfacing. So these guys all have products that are secondary market focused. I think that we haven't yet talked about technology-enabled secondary market investing, which opens up the whole conversation of ICOs. So I don't know if you're going to ask us about that, but I think that's another piece of this puzzle.
Well, I didn't have any questions on that particularly. Would you like to say a few words then?
Not necessarily, but I think the tokenization of assets, so to the extent to which assets are private longer, this question of access and how does capital flow into those opportunities is on the table. Sven and Craig and Michael are creating products that allow a disorganized, difficult to access market to have some liquidity so that capital can flow to opportunities. And they do it in 3 different ways. Systematically, if this persists, and if we've abandoned the public markets, then technology-enabled secondary market trading of private assets is the story of the future. And that is where blockchain and the tokenization of assets comes into the conversation. Because that's sort of a technology platform being designed to facilitate the transfer of value on private assets. Whereas everything we did from the Big Bang onwards was about bringing technology to public markets. And as you know, almost all public market trading today is done on technology platforms, but almost all private investing is done by guys going and finding deals, and girls doing deals, writing docs, taking share certificates and putting them into funds or mutual funds or other vehicles. So I am actually quite serious when I say that the tokenization of assets is likely to be the future of private trading in private assets. And I think the SEC is also thinking that through. You know, what should they allow and approve, because this likely is going to be not billions of dollars, but trillions of dollars of market trading that is now being unleashed.
Yeah, 10 to 20 trillion in the next 2 years.
Well, thank you. I don't have a projection, but the reality is that if we withhold corporate equity from public markets, then we're going to have bigger and bigger platforms upon which it can trade. And I do think tokenization is an obvious one. I'm curious what you guys will think about that, by the way.
Yeah, you know, I saw the founder of Harbor speak just a couple days ago, and he's the founder of a company that's working on the tokenization of securities. They're focusing on real estate, but he was out there and he was really evangelizing the concept. And you're right, I mean, there's a lot about the process that is very archaic, just, you know, the transfer of shares, certificates, and all that stuff could be vastly improved. But I do think, you know, I've kind of seen some of this story play out before in sort of the early years of the direct secondary market, or it had been around a while, but kind of in the 2010, 2011 period when Facebook and Twitter were trading a lot pre-IPO. And platforms like Second Market and others came into the market with the vision of making this market more efficient and transparent. And they did, they added a lot of value, but I think the vision of kind of emulating the public markets largely was not realized. And I think, you know, to your point about having information, you know, my experience during that time was that that was the main hurdle. You still have to have transparency and you know, have the issuers themselves trust that it's going to be handled well with people that they trust. And that was not addressed or kind of fixed at that time. And I haven't seen from the visions from these tokenizing platforms that that they will overcome that hurdle.
Do you think the B Corps are doing it? Because they broke open the door for the Jobs Act. Sorry to interrupt, but we actually work with the guys at the B Labs. And because they were able to open the data about it for non-accredited and offer either an interest rate return or preferably a dividend, it's a reasonable replacement of what used to be the actual penny stock space, which is now transparent. And I know they actually collaborated with California law, and that actually forced the Jobs Act for them to issue guidance. So I think that's a model because there is transparency and a reasonable return that you can track and monitor. I know a lot of the guys over at the NASDAQ labs are really focused on that. What do you guys think of that space as an option for companies to get capital and liquidity?
I don't know that space.
Yeah, it's a good thing to look at. They did like 300 million, 15, the largest raise was 13 million 2 years ago in the East Bay. They actually forced the actual SEC to do guidance. I was under Obama. But back to you guys think about shares.
It's just getting back to tokenization. So you're a strong believer, though. Sharespo's trading system actually is one of the few systems approved by the SEC to do tokenized transactions on an alternative trading system. So it's definitely moving that direction. I'm not 100% sure who will drive it. I know it will come because I see not only the private market but also the public market. It's a highly inefficient process if you look at transfer agent processes, custody processes, even in the public domain. This is ridiculous. And then they're actually moving physical stock certificates from one custodian to another, even in the public market. So they are big initiatives outside what we see in the private market, in the public market, that everyone understands that like, the moment you can tokenize or have a digital representation of the title of ownership in a security, this is what it all is. It's nothing more, nothing less. It's a digital representation of the title. If you can overcome all these inefficient processes that you have today in custody and transfer agents in the public market, in the private market, it will just force a change. No question. I feel a little bit, what I see is often people mix cryptocurrencies with the tokenization of securities. They're two totally different things. I'm a strong believer. I think it will come. There's no way out, and it will touch the private security space, the public security space. It touches everything that is a title to your music collection. Yeah, is what you actually own on digital assets. Today, you cannot. Technically, you cannot give your digital music collection to another person. You don't have the title transfer mechanism to this. If you think about all of this tokenization of titles and securities is coming, I'm not sure if the private side is the driver or if actually cost savings on the public side are the driver, but it's coming.
And I think on tokenization, one of the nuances that I'm curious to hear the rest of the panel take on is you separate out the format that the title's in, which is, it's a digital token or physical stock cert, with the transfer restrictions. I think the important piece is the transfer restrictions, because if you think about the reason why we talk about ROFRs and board approval rights, like the reason they're in there is because the company and the board want control over who gets on the cap table, right? And so I don't think just changing the form, like even if private stock does become tokenized, I think the transfer restrictions still remain in place because like they put them in place for a reason, right? And so I actually don't think that we're going to see kind of these freely tradable markets, because that basically resembles a public offering.
I think the other dynamic that's just to reiterate the point, I guess, in a different way. In America, there's only 4,500 public stocks. There are 9,000 hedge funds that create permutations of those 4,500 stocks. There's 16,000 mutual funds and index funds that permute those 4,500 stocks. And there's 680,000 brokers and RIAs that helped people invest in everything that was built on those 4,500 stocks. The reality is anyone in this room can buy any one of those 4,500 stocks relatively easily at very low cost. So everything else I described is really just cost. It's cost on cost on cost. And it's derivatives and it's other things, but it's fundamentally unnecessary. And so back in the olden days, my wife was CFO of Barclays Global Investors, where they suddenly understood that ETFs were cost-efficient ways for institutions to invest in these stocks. And so today, most institutions invest in stocks through to ETFs, and most of the other costs went away. Then we had the big thought, well, hang on a second, if we take a institutional ETF and we provide it to the retail customers, it'll be lower cost and therefore higher performing than 3% low mutual funds from Fidelity. And of course, iShares wiped out the entire mutual fund industry of the US and is now $2 trillion. So the reason I'm saying all of these things is because that's really what's happening. The capital is not returning high returns. There's a lot of cost in the way, and there's this enormous demand for positive return, which is in emerging technology companies. And in this time frame, the most efficient way to access it may be to go to a Sven or a Craig, right? But that can't be the right answer. Sven has to go and bang on doors, hunt down employees, get them to sell something, put it in a mutual fund and trade it on an old platform that was created 50 years ago, the public market platform. I think we're ripe for disruption. And obviously, Spotify is also, by the way, an interesting one. We had sold the company to Spotify, Soundwave. So we saw some inside information from Spotify because they were giving stock in lieu of cash for the acquisition. So I came to Michael and said, I want some more Spotify. But when Spotify did its IPO, it tried to disintermediate Wall Street. It tried to do a 100% direct offering. It ended up being a hybrid. So they still use the investment bankers, but they shrunk their costs by maybe 100 billion. Well, the next thing for a Spotify would have been to say, well, hang on a second, we have 1 billion users around the world. Many of them want to have a piece of Spotify. Maybe we should have tokenized it and let Spotify people, fans, invest directly in Spotify and just save the other 100 billion. So I think it's a very interesting time we're living in, and the secondary markets for technology companies are only going to get larger. And the ICO markets also demonstrate this, which is with all of the noise and the problems and the issues, there's billions of dollars of money trading hands right now in technology offerings, which last year we didn't have. It's come with a rush.
LiLing, mind if I jump in and ask the panel this question? And Matthew kind of alluded to it, how the popularity of the private equity markets and secondary transactions, it continues to get bigger and bigger and more liquid and more efficient. What's going to happen with the IPO market? I mean, we all know that companies are spending a lot longer staying private before they go IPO. I mean, there really isn't much cachet anymore for going public. We have some examples with DocuSign and Spotify and some others, but have gone public recently. But what's the outlook for the IPO market? What do you guys think about that? Because in view of this really active secondary market in private equity.
Well, I think we over focus on the public market for years. And it's just, I also find this mind-boggling. If you look at the hard numbers, if you really look at the companies you're talking about here, the late-stage tech VC-backed companies, if you run a statistic over the last 15 years, you have on average about 8 to 9 IPOs per quarter, with a standard deviation of 3, which is exactly the statistic error. Yeah, square root of 9 is 3, that is the statistic error. And we have that, an average 8 to 9 with standard deviation of 3 when people say, oh, it's a bad IPO market. And we have that when people say it's a good IPO market. The only difference is that normally when people say it's a good IPO market, you have 1 or 2 of the 8 who are more prominent, and then you have a few quarters where you have less prominent companies going, and everyone says it's a bad IPO market. For 15 years, run the statistic, we have that average 8 to 9 standard deviation swing. That's it. At the same time, you have 200 to 250 acquisitions of these companies. Yeah, so I'm just like this, so what? If the IPO market goes away, so what? I don't care. I care about what happens with the acquisition market. Because that is 97% of the exits. And where does this go, and where are the trends in the acquisition market? And I think we're totally hung up on the IPO thing, and I agree, this will move even later out. You will have tokenization, all the ICO craziness will hopefully be more normalized at a certain point, and you have real kind of companies doing stuff and doing offerings. Not right now, we can assume that 95% of the ICO offerings go somewhere, but not where you want it. But there will be something, but we're too much focused on the IPOs. What's happening in the M&A market? That is the major source of liquidity. And where you have to look is how much cash flow corporations have, who's buying whom, are they buying to a premium or not, how do they behave in a down market, how do they behave in an up market, all of this. I think you will see the trend. The trend started at 4,000, actually it's just 4,115 public companies. That's even getting less and less by about 30 per month. If you looked at 1996, you had 8,200 public companies. So this went down from over 8,000 to just 4,000. The Russell 5000 doesn't have 5,000 companies in it. Yeah, they have to rename itself every month and just count down. Like the shingle cities put on and say what's the population, but they probably have to replace that shingle every month, rename their index. You have less and less companies. You have more and more money and chasing less and less companies, to your point. And a lot of the public stock rally you saw was just driven by that factor. It's a supply demand thing. But you see now this money starting flowing more and more in this kind of a new asset class, which I believe sits between classic venture capital, which I define as companies and with financing rounds up to $100 million. This is for me classic old school venture capital. Funds, VC funds, if you look at the VC fund size, take the $6 billion Sequoia thing out that was just announced. The typical VC fund, if companies might do larger financing rounds than the fund size of their VCs, they have outgrown the VCs. That is not classic venture capital. And the line I'm doing is, if a company starts raising more than $100 million in a financing round, this is not classic venture capital anymore. If you look 30 years ago, this company would have gone public, period. Today, you can raise $100 million, $500 million, $1 billion, billion, $5 billion, go to the gas station SoftBank. Yeah, you get as much money you want in the private market. You're not forced by the regulator to go public. Yeah? There's 2,000 shareholder rule, excluding the employees. None of them has 2,000 institutional investors. And the private secondary market, which is getting more and more efficient, and even more efficient if you tokenize this. This is just, the public will not be there.
Yeah, I agree altogether with Sven. I mean, you could say it another way as well, which is, if there is unlimited capital directly flowing into the fastest growth disruptive technology companies in the world, what does that say for one minus those companies, right? It's massive adverse selection. It says the other companies, the capital is flowing into low growth, low prospect, and undisruptive companies. At a macro level, why would you invest in those, right? So the public markets are the place companies go, the place dying companies go to continue to raise their capital. And the private markets are the place where the companies of the future raise their capital. The problem is there's 680,000 people in America who don't want anything to change. And that includes, you know, when you hear CEOs of banks say, you know, all of this is bullshit, and the next day it's announced they'll no longer be chairman or CEO of their own bank, and their own bank is betting high on the future of this same technology, you know something's going on, right? When you hear Charlie Munger say it's all crap, well, it's, you know, in the internet boom, Charlie Munger famously said, the internet is not going to be good for business, it may be good for customers, and a lot of value is going to be destroyed. And then it took him 30 years to invest in Apple. So the established players are on the wrong side of this conversation. You know, of course, technology-enabled investing is the future, and therefore, private market investing, as we currently define it, is more the future. And therefore, secondary market trading in private opportunities is more the future. And the public markets are going to continue to decline.
And another data point, if you look at the GDP growth of the United States in the last 15 years, all of the GDP growth is driven by technology disruptive companies. If you look at the growth of employment, 80% of the employment growth is driven by these companies. So in some of the discussion, I have a similar talk about it. It's at a certain point as an investor, you have to decide, are you on the losing part of the GDP, or are you on the winning part of the GDP? Where do you want to place your bet when you invest? Yeah? Nothing. There's a lot of risk in what we're doing. And we know not all of these companies will make it. Yeah, and you're losing money too. But the grand scheme is always, if you look at the black box, what counts is money in and money out. And the trends for this, what we're representative here, all they're doing is speaking for itself. If you look at the black box, how much money is flowing in, how much money is flowing out, what are the trends, what is the market looking without it, and that's why it is possible to raise these amounts of money in the private market.
I think I have maybe a slightly different view in that I think things tend to move in cycles, and I don't think public markets are going away as a major source of capital anytime soon. And the way I think about it is, even though SoftBank has a really long fund life, they have to exit somehow as well. And I actually predict, based on some of our diligence with a lot of banks, ECM, equity capital markets teams, that second half of this year will be an outside of one standard deviation event in terms of venture-backed IPOs, especially post-Labor Day. So time will tell if that plays out, but that's my prediction.
Cool. Let's hope.
All right, well, I think that concludes.
So more than 12.
Yes, on the record.
Just 1 quarter or on the continuous?
Especially Q3, yeah. So more than 12 in Q3.
I hope it's not just 1 quarter.
International or domestic?
Is that the Trump effect?
Name them, he knows something. He's got
International or domestic?
Yeah.
I'm mostly focused on domestic, so I think it's just U.S. venture-backed IPOs. Yeah, more than 12.
What do you think about people like Temasek that doesn't force their companies in portfolio to IPO? I mean, we're seeing a lot of heat around their investment. Full disclosure, we advised the company. They put $114 million in, and another one, Grab Taxi, that kicked Uber's butt in China and Southeast Asia. So, I mean, they're doing pretty good for the country of Singapore, and they're a model that can scale. There's a lot of the private capital we've seen come in, even into Uber and others, that could look at the return model like a direct public offering does, a DPO. So I kind of wonder where the juice is for the people with the big wallets. I don't see a lot of juice for just the traditional VC. I don't see that. Even Ron Conway's pulled it back. So I don't see the juice for me as a guy who's helped build 2 hedge funds, algorithmic hedge funds, to actually, why should I put my money behind the traditional model and try to find the right guy to go take that kid out to lunch and dinner and get him to sign? I'm actually ex-Apple, I gotta say that.
And Grab Taxi's done really well in Malaysia.
Oh yeah, Philippine guys, yeah.
Oh yeah. You guys, thank you very much for the panel. We really appreciate that. That was fantastic. So thank you so much for leading.
Good to chat to you again.
You was great. Spanish,
happy with me
we
the second.
reversed the order tonight, but,